Hi, today is July 30th, 2022. I'm Jason Shapiro with Crowder Market Report. Um, what I thought I would get into today is the concept of time um, and its adversary, patience. Um, and what I mean by that is like, you take, for example, right now in the markets, the bearish side, which is still pretty prevalent, is that the economy is going to be heading into a recession. The Fed is raising rates into a weakening economy, and it's going to cause recession. And recession is bearish for the stock market, and therefore the stock market's going to go down. And that may be 100% right, okay, but it doesn't mean anything in terms of what the market does over certain periods of time. Um, Back in June, I was getting long stocks, okay, and simply because everybody was getting short, right? And I made the argument back then that, and you got to understand, I'm no clairvoyant, okay? This is just, I'm backing into the analysis based on where I think the market's going to go. So I'm bullish stocks. I think the market's going to go up. Well, why would it go up? Well, people could start making the argument that the Fed is coming to the end of its rate rise, and therefore they're going to stop raising rates, and rates are going to start going down, and lower rates are bullish for risk assets like stocks, and therefore they could start buying stocks. So that's kind of what the bullish argument is, now, 2 months later, where they're saying exactly that, right? Oh, September might be the last rate rise, and therefore, and to me, it's all just a narrative chasing the market. It's all it is, right? I don't know if they're going to stop raising rates in September, and even if they do, I don't know if they're going to re-raise in December or what. And nobody knows, right? And if they tell you that they know, they're lying, right? It's, to me, it's not about that. It's about everybody was short, you get long, and when everybody's long, you get short, and that puts the risk reward in your favor. My favorite market to sort of talk about this concept of time and all that is the Nikkei, which is over here, okay? This is the Nikkei at the end of 1989, 39,000 and change, okay? This is the Nikkei now, 32 and a half years later, right? It's at 27,000 and change. It's down 28% in 32 and a half years, okay? At its lows, which was here, which was the low of 2009 after the financial crisis, it was down something like 80%. That's 2009. This is 1989, okay? What's that, 20 years? High to low, 20 years, okay? High to down 28%, 32 and a half years, all right? That's a long time. But in the interim of those years, all right, and there's more on this on my weekly report where I really went through basically every 20% move in that time period. But I counted 39 20% moves in that time period, right? Down 19, so maybe I went to 19. Up 28, down 61, up 60, there's all kinds, up 26, up 88, down 39, up 34. I'm just kind of reading these. Up 68, up 62, down 31, right? These are big moves. You catch a 25, 30% move in the market, you're pretty happy. And the point being here, during this period from here to now, Japanese GDP has doubled, okay? Japanese interest rates have gone from 8% over here to 0%. They were zero all the way here, right? But it didn't matter. If you sat here and tried to forecast what the Nikkei was going to do based on GDP and interest rates, you'd be pissed. You're spitting in the wind. If I told you, hey, here's an economy that's going to double and interest rates are going to go from 8 to 0, what would you have told me the stock market was going to do in that time period? Would you have told me it was going to be down 28%? Would you have told me it was going to be down 80% over 20 years of that? I doubt it heavily, right? So the point is, what you want to do is catch these 25% moves. Who cares what the economy's doing, right? And the way to do that, of course, is when they're way too short, you get long, and when they're way too long, you get short. And in case you want to make the argument, oh, well, the U.S. is not Japan. Japan has a big aging problem, and blah, 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 and that's deflationary and all that. Okay, well, here's the S&P. The S&P topped in November of 1968 at 9,907. It bottomed in March of 82 at 351, okay? That's a 68 to 82 is what? 14 years of down, right? And you can go all the way to here, which is 95, somewhere in 95. We were at the same level it was at in 68. That's 17 years, 27 years. 27 years where the market went nowhere, right? But again, just quickly looking at it, all right, in the interim, from the first move down was down 40% in 8 months. Then you were up 47% in 29 months. Then you were down 54% in 27 months, up 46% in 18 months, and down 38% in 6 years, okay? So those are the moves you want to catch, right? And if you're going to sit here and focus on the economy and the interest rates and this and that, I think you're wasting your time. You're going to lose money. And just another note on that, from 82, when we bottomed on this S&P, right, over here, to now, right, you have to keep in mind interest rates went from 18% basically to zero, right? And I can tell you that that's not going to happen again, because we're not getting the 18%. If we get the 18% in interest rates, first of all, you better not be too bullish, but we're not getting that wind at our back again. So to me, the most likely event is we're going to have a long-term market that is not going to go anywhere, most likely down net. But in the median, while that goes on, there's going to be big moves to catch on the long and the short side. Who cares which way you make money? Just make money, right? And that's really the lesson here, right? Time is long, right? These moves, 6 months, 8-month moves. Like, let's say everybody's right about the stock market. We're going into recession, and the economy's horrible, and the Fed can't do anything about it, and blah, blah, blah. Make the most bearish argument you can make, and the stock market's going to go down 80% in the next 15 years. Well, if we get 15 years from now, we're in 37, and the stock market's down 75, 80%. Did it make any difference that it went up 20% in the summer of 2022? It'll mean nothing. You go back and look at the chart, it'll look like nothing. But trust me, you catch a 20, 25% move in, a 4 or 5 month period, it means a lot, right? And that's what you want to focus on, right? When they get too short, get long. When they get too long, get short. Forget about this long-term ideas of, the macroeconomic situation. And just as one more note, why do I think the market's not going to go anywhere for a long time? What it really comes down to me, is if you look at the numbers of how much money went into the stock market since COVID in 20 and 21, it's records. It's massive amounts of money. I don't know the exact number, but it's something like those 2 years had more inflows into the stock market than the previous 20 years combined, something like that. That money does not earn positive returns over time, okay? It's just not that easy. The mass money does not earn positive returns over time, so it's going to bleed. If the market crashed, it's almost too easy. Okay, it crashes one day, okay, you buy it, and eventually it'll come back, right? But if it slowly drips and it has these rallies, 25%, 40%, whatever it is, keeps you in, right? Keeps you happy, and then all of a sudden it goes down 40%, and then it bounces 30%, then it goes down 30%, then it bounces 20%, then it goes down 40%. That's the killer. You can't get that time back, okay? You come in 20 years later and the market's down 70%. That's a hell of a lot worse than coming in 20 days and finding it down 70%, right? That's the biggest pain trade there is out there based on the money that flowed into these markets in the last few years. And that is really what I believe is going to happen. So there's plenty of movements in that period to make that happen. The market has to go up for periods of time if that's going to happen, and go up a lot, because you have to rebuild that long base. And just mathematically, the market can't go down every day, because if it does, it's going to be zero pretty damn soon, right? So it has to have these rallies, goes back down, has these rallies, it'll be consistent. But the good news is, 20, 30, 40% moves, there's a lot of money to be made there. So again, time. You can have it be your enemy, or you could have it be a friend. Let's make it our friend. Okay. All right. Thanks. If there are any questions or comments, let me know, and we'll see you next week. Thank you.